Hi, I'm Eric.
And I'm Dick. We are the Annuity Guys.
Dick, we're looking today at whether or not fixed indexed annuities are the best options for retirees.
Well, Eric, we've been proponents. We have to come clean here. Fixed indexed annuities.
The annuity guys like annuities. Oh, no.
Well, in the fixed indexed annuity, I mean, we're very up on using annuities where they belong, the different types of annuities. But really, the fixed indexed annuity has had so many positive aspects to it that even before they were really popular, back, I remember around 2006 and that. And let's just say, fixed indexed annuities, folks, they're not new kids on the block. They've been around since 1995. And so, but back when they were still just kind of, being questioned, if they're legitimate, back in that 2005, 2006 area, I was working with clients, and you and I have really been talking on our videos about them quite a bit.
Yeah.
But yes, Eric, I do believe that if it isn't the best, because everybody's situation is a little bit different, it is one of the best solutions for retirees to have a very safe, kind of a set it and forget it type retirement.
Right, and we should probably back into a little bit how these kind of work. And so for those of you who aren't familiar with how a fixed indexed annuity works, it really allows you to take a benchmark. So you put your dollars into the annuity and you select an index. Now, some of the more popular ones out there are the S&P 500, the Dow, the NASDAQ, but there's all sorts of indexes available.
And new ones that are being created.
Right. So you put your dollars in and you're basically set a time and a point. And if you think about it, basically, the most common ones are like an annual point-to-point, where you're going to get credited based off the growth of the index a year from now. So you look at it today, if it's at, let's use an example of the index is at 100, and a year from now it's at 110. You had a 10% gain.
Yes.
Then your index is potentially crediting up to that gain potential.
Right, and usually it's cut back from there. So if it was a 10% gain, you may be getting 5% or something of that nature.
And that's where the caps, the participation rates are. But the best part about the indexed annuity is, let's say that index went from 100 to 90, then what happens?
Well, you don't lose anything. You don't go backwards.
And that's what I think the strength of the indexed annuity really is. We've been big proponents for retirees of understanding the sequence of returns. And it's not usually so much you taking your own dollars and spending them in retirement. It's when the market decides it wants to take a big chunk out of your retirement.
Right along with you.
Right. So you're taking your dollars out, and then all of a sudden the market's taking extra dollars out. You've got a reverse compounding effect of the fact that you're going down a much more quicker slope.
Right. You're going to run out of money. It's kind of that simple. And Eric, there's other types of annuities besides the fixed index, and for some folks they might be a better solution, such as the immediate annuity, where folks just need a start income right away. They need to know that it's going to be there as long as they're going to be there, similar to a pension. And maybe they don't have heirs to leave the money to. It's not important. So there's several factors on an individual basis where you may want an immediate annuity, but then there's other factors that cause, again, the vast majority of retirees to go, well, I'd like to have some control over my money, should I need it back. I'd like to be able to get money to my children, if I would die prematurely, or even if I live a long life. It would be nice to have potential to have some serious money still there for my kids.
Exactly.
And then to be able to guarantee lifetime income and still maintain control and still get money over to kids. And that's what this fixed indexed annuity does for folks.
Yeah. For me, I focus in on two things: growth and control. The ability to still get some growth. And we're not talking about market type returns here. We're talking about probably trying to beat the bank here on most days, or most years. You're trying to beat the bank's return. So you have that potential to get that upside. You put a breaker on the downside, but then you've got the flexibility. You've got majority control. Now, we're not saying that these don't have surrender charges, because they do. And they're really stiff in the first few years.
Yes, they are.
So you don't want to go into these thinking that you've got fully liquid money, although typically you do have some liquidity.
Some liquidity from it.
5 to 10% is pretty normal these days. you've got that chance for growth, but you still have the majority control.
Right.
Even on day one, worst choice that you decided
Worst
you had
case,
to get out,
yeah.
you still got control over typically about 90%.
But yeah,
of the
90% of your money, and I mean, we're looking at corrections in the last week, Eric, in the market where folks, if they needed their money right now, they'd have to take
Potentially, yeah.
10% less,
Yeah.
or thereabouts.
So exactly.
So again, when you start thinking in terms of the fixed indexed annuity compared to the immediate, which we talked about.
Sure.
Now, if we compare it to the variable annuity, because when we start talking about the market and benefiting from the market, the benefit of the variable annuity is that it kind of has that unlimited market upside.
Right.
Also has that unlimited market downside.
Right.
So
the best way I can describe a variable annuity on its base shell, it's basically a mutual fund with a tax deferral wrapper is how I tend to think of the best way I could explain how a variable annuity is on its basis. And that's why a lot of people end up having to add the riders to get the other benefits that you see on some of these other annuities in order to make it worthwhile, because really you're looking for some sort of safety net there.
Right.
And
well, we've taken the stance on variable annuities that for most folks, if you're going to have that market risk, you might as well avoid the fees of the variable annuity and just have the market, just be in the market, have a nice market-based portfolio.
Yeah.
And so if you're really in the variable annuity for the future income, then you're better off looking maybe at something like the fixed index annuity, where you've actually got, in almost all cases, you're going to have a better income number as that annuity is deferred. Based on the guarantees.
Yeah, and we should put one caveat there. If you're a believer that the market is going to go straight up, then you could actually buy a variable annuity.
And just stay in it, and ride that rocket.
And you wouldn't need the income riders or those pieces, but usually that's not the case.
Yes, exactly.
So, now, a lot of people do get the fixed indexed annuity confused with the variable annuity because of the indexes.
Yes, because
when you're saying the S&P 500, well, aren't my dollars invested in the S&P 500 if I select that index? And the answer is actually no.
Right.
You're just using that index as a benchmark.
Yes.
The insurance companies are one responsible for actually making and doing the investment side. And if my understanding is correct, they're typically using options contracts to leverage the actual ability for those those indexes when they hit. That's how they're able to then share those benefits with you. And if they don't hit, they expire worthless.
Exactly. There's simple call options, and they purchase those options based on the length of your reset. And again, they do it from a pooled perspective with everyone's money, that they're protecting. And so there's really virtually no risk to it. The big risk is that we may not make money this year, but we will not lose money.
Right, and that's the key. It's not going backwards. There's lots of other pieces we could probably get into on the indexed annuity.
Yes.
But I think ultimately are they the best option for retirees?
Well, Eric, I think that if we take the individual situation and we look at it, there will be some exceptions. But I do think that for some portion of most retirees' money, that there's a place in their portfolio to have a
allocation,
closer to a set it and forget it type retirement. Using maybe that money they would have used for bonds or some portion of their portfolio. Yes, I think the answer is it really is one of the best choices.